Guys, can you hear me? Everyone? Guys, can you all hear me? Guys, can you all hear me? Okay, I'm so sorry for the delay in starting the class because there was a mess up with the link, I believe. I'm so sorry, but we're back and we will commence now, right? Okay. Uh, well, I'm sorry regarding the class cancellations, right? I was being very sick and I couldn't had a problem with my got some mouth ulcers and now I believe I'm fine. Thank you. I couldn't talk. That's the issue. But anyway, we're coming back. We're starting. Mm, guys, I've been getting messages asking me to do some income statement balance sheet question. Yes, income statement balance sheet is one is an important part of your syllabus. It's very crucial. So you've got to be prepared for it. Yes, in our revision program, we started off with ratio analysis. We did consolidation. And then let's start off with some income statement balance sheet. And frequently I'm getting messages asking me to do this question called YGEM. YGEM is a consolidation question. So I'm trying to cover some standards in terms of income statement balance sheet. And I'm also trying to see if I can complete this question called YGEM. But if you have any other questions that you want me to do, please share across because I want to meet you again during this week also. This is not my last class with you. I want to meet you if you are fine with it, even before the exams 1 or 2 days. Right. I thought I'll pick this question. This looks a bit technical and it looks a bit challenging. Some of you have requested me to do this question, which is uh, Fresco and Clarion, both. I've got messages asking if I can do Fresco and Clarion. I'm fine. So we will start off based on the messages that I got only I'm going to do. So I'm going to start off with Fresco. But guys, when I'm doing this question, I'm going to take you through the standard also so that you understand and I will be giving you some shortcuts for the exams. Okay, brilliant. Now, obviously, you are in the examination hall and you are going to get something like this in the exam. Yeah. Let me connect. Okay. So, like I've told you, you're going to leave about 50 lines in the exam. You're going to come right to the bottom and you are going to say workings. In the exams, this will be the pattern of you answering. What happened? Yeah. How did it fall? Okay. Too many distractions, right? Okay. You're here, right, everyone? Okay. So, in the exam, I want you to come right to the bottom, leave about 50 lines and say workings. Okay. And although you have your workings here, you're going to start doing your questions, answering your answers here. Why does it keep on falling? Okay, I think we're much more settled now. Okay, brilliant. Um, guys, your examiner gives you the question. There are notes when it comes to income statement and balance sheet. So you will read the entire question. You will read your notes. Every note will have a working to do. So the workings will be adjusted here. So once you're done with the note, it's the workings which matters to you. Based on the workings, you will answer the question. Okay, we're going to take the route. Shall we, everyone? Everybody, onto my screen. Right. Let's go to Fresco and let's start answering. Now, guys, something like this is definitely possible in your exam. Now, here you have a question which is worth 20 marks in the exam, right? It's tested in every exam session. It is there in every exam session. I'm going to take you through this entirely and show you how to work around a question like this. Okay. I'll be slow because I'm going to explain you some standards also when connecting this to the answers. Before that, the requirement says prepare the statement of P&L and other comprehensive income. You know the P&L and other comprehensive income for the year ended 31st March 2012, and then prepare the statement of changes in equity for Fresco for the year ended 31st March 2012. It's only the statement of changes in equity. They do not want you to do the statement of financial position. But let's see if possible, we'll try to do the statement of financial position also. Okay, brilliant. Everybody, can we start? Everybody, can we start? Everybody with me? Okay, brilliant. Take a minute, start reading the question on your own. Take a minute, start reading the question on your own. Just read the question and then we'll do it together. Just go through the question on your own. That's enough. Once you go through, give me a done, okay? So we didn't receive the recorded videos of your attending mock exams. Really? Okay, let me look into it. Don't worry. Let me look into it. Okay, done. Others done? Done? Gone through entirely? Only now I'm scrolling down. How can you go through entirely? Ah, you went online. You have the book with you. But I saw your revision kit. No, you might have. Yeah, but your revision kit will definitely have it. You got it right? Okay. Right. Guys, let's go to the question. The trial balance, the following trial balance extract, it's an extract from the trial balance, relates to Frisco at 31st March 2012. What do you have? You've got equity shares. You've got equity shares of 50 cents each. 45,000. So when they say equity shares of 50 cents each, basically the total value would have been 90,000 shares. 90,000 shares at 50 cents means it gives you 45,000, correct? That would be your total number of shares. This is your value of shares. 45,000 is the value of shares. Number of shares is 90,000. Clear? Share premium. You know share premium. When your shares are issued at a premium, at a higher value, you have a premium. Number 3, retained earnings or profits accumulated over a period of time. Number 4, equity financial assets, IFRS 9 financial assets. Leased property, IFRS 16 leases. Plant and equipment, IAS 16, amortization of leased property, accumulated depreciation of plant and equipment, deferred tax, IAS 12, revenue, IFRS 15, cost of sales, once again, lease payments, they've made for 8,000, I believe, distribution cost, admin, bank interest, current tax, and there is suspense account. So basically, suspense account means what is happening, there is a difference. Your trial balance will have to balance. No, guys, it's not balancing. Because it is not balancing, probably you've done an error, you've made a mistake. That mistake is for 13,500. That's what your examiner says. Are we clear? Super. And then they've given you the notes. Now, guys, based on the notes, you're going to do the workings. That's how it has to be in the exam. The following notes are relevant. The suspense account, meaning they're referring to this. Correct. The suspense account represents the corresponding credit for cash received for a fully subscribed rights issue. Meaning they've gone for a rights issue. When they've made the rights issue, they have accounted for the share issue. However, they say a suspense account represents the corresponding credit for cash received for a fully subscribed rights issue. The debit, when you're issuing shares, you credit your share capital, you debit your cash. So your debit, your cash received is accounted. The corresponding credit was not accounted properly. They say for cash received for a fully subscribed rights issue of equity shares made on 1st of January 2012. The terms of the share issues were one new share for every 5 held at a price of 75 cents each. Meaning, you go for a share issue, you make a share issue, you are going to debit cash or bank. Correct. You're receiving money. And then you are going to credit what? Share capital and share premium. Share capital with nominal value, share premium with any additional amounts. Here they say the debit side of it is adjusted. But the problem we have is on the credit side. So credit side, they have not accounted it correctly. Because they have not accounted it correctly, we are going to record it. Are we clear? Technically, you have how many shares? You have 90,000 shares. We just calculated on top, correct? 45,000 divided by 2. 45,000 divided by 0.5. 90,000 shares. So 90,000 shares, guys, you're issuing at 1 for 5. Correct. So if you're a shareholder, now rights issue, the concept of rights issue is basically if you are a shareholder, the company is going to give you shares. Company wants money. Now let's say PPI wants money. We don't have enough money. For our money that we have to require, the money that we require, the capital, either I can go to the bank and I can borrow from the bank, or I can go to my existing shareholders. If I decide to go to my existing shareholders for money, for my capital, we call it a rights issue. Rights issue is normally given at a lesser price than the market value. It's a benefit to the shareholder. If the market value is, let's say, is $1, you can get it for maybe about $90, 0.90 cents or 0.80 cents at a low value. So in this case, they are issuing at 0.75. So 90,000 shares into 1/5 into 0.75 is the value. So basically, how much are you looking at? You are looking at 90,000 into 105 into 105 into 0.75 is how much? Let me go to my Excel and do the calculation. 13,500. Sir, I'm very sorry to interrupt you. Your video is blurred. Is my video blurred? My video is blurred. Okay. Arutra says no. Others? No, it's not blood for others. So probably it can be a problem in your end in terms of internet, Akash. Can you just log out and come back, please? If you're fine with that. Okay. Okay. Now, basically, what I'm going to do is I'm going to do my W1, working one. Okay. Now, there is a share issue. What is the terms of issue? You have 90,000 shares with you. Am I right? You are going for 1:5 ratio, rights issue. For every share that you are issuing, you are giving off at 0.75, meaning equals 90,000 into 1/5, new shares 18,000. 18,000 will be your new shares that you are going to issue, correct? That you are going to issue. Price will be 0.75. So total value will be equals this into this 13,500. Are we clear? Now, basically, when you look at this question itself, by now you know the 13,500 is already there. Are we clear? 13,500 is already there. But they have not accounted the credit side of it. The debit side of it is accounted. Now, the debit side of this will be debit bank. No, guys, you're going to debit bank how much? 13,500, correct? The credit side of this will be credit share capital and then credit share premium. Share capital, guys, you will only always credit with what? Nominal value. So total number of shares is 18,000 that you're issuing. What is your nominal value? What is your nominal value? 0.5. So into 0.5 is your share capital, which is 9,000, and the remaining will go as share premium, meaning 0.75 minus 0.5, which is 0.25. So equals 18,000 into 0.25 will be your share premium. Are we clear? Are we clear, everyone? Yes or no? Are we clear, everyone? Yes or no? Understood. Super. Now let's go further. Okay. In the exam, you need to keep in mind that this is done. If this is done, this is a problem. No, I mean, this note is a problem. The problem for this problem, we've got the solution. So once we have the solution, we're not going to go to the problem again. In the exam, I'm not going to come to this particular area again at all because I'm done solving this problem. So my workings are good enough for me to prepare my financial statements. So this is done. I'm going further. My note number 2 is non-current assets. They say to reflect a marked increase in property prices, Fresco decided to revalue its leased property on 1st of April 2011. Now, when is this happening? So, coming back, to reflect a marked increase in property prices, Fresco decided to revalue its leased property on 1st of April 2011. 1st of April 2011. Now, what's your year end? Let's go back. What's your year end? Your year end is 31st March 2012. So from 1st of April to 31st March, how long has it been since you revalue? Huh? 12 months. Super. The directors accepted the report of an independent surveyor who valued the leased property at 36 million on that date. So you had an independent valuer, an expert, who came in and who said the value of the property is 36 million. So that means your fair value is 36,000 on that particular date. So you are going to do a revaluation exercise, no, my dear. So when it comes to a revaluation exercise, you compare your fair value with your book value. So now you have to get your book value. Now you have your fair value. Now you need your book value. Are we clear? Book value, how to get? You can go to your trial balance and you can get your book value. Now, what are we revaluing? We are going to revalue the property. So if you come to the top, they have property. There you go, lease property. The value of lease property is 48,000. And then you have what? Accumulated depreciation. So the net book value would be your property's cost minus accumulated depreciation of 16,000. How do you revalue? For your revaluation, you require your fair value, the revalued amount, and your net book value. The difference between your net book value and your fair value will give you your revaluation gain or loss. So basically here, when you look at this particular particular adjustment, that is working number 2, is revaluation. Is revaluation. For revaluation, what do you require? Net book value and fair value, correct? What is your net book value? Your net book value will be 48,000 minus 16,000. How much is that? 32,000. Are we clear? Are we clear? How much is your fair value? Your fair value is 36 million. So 36 and 32. Do you have a gain or a loss? What do you have? You have a gain. So there is a revaluation gain of how much? Gain of 4,000. Now, how do you account for this revaluation gain? Your asset value is going up, no? So you're going to debit your property account and credit your revaluation gain account. Surplus account. Everybody, are we clear with that? Yes or no? Everybody, are we clear with that? Yes or no? Clear? Super. Now let's go further. Fresco has not yet recorded the revaluation. So we recorded it. So that particular adjustment is done. The remaining life of the leased property is 8 years at the date of the revaluation. So when you revalue, at that point, you are calculating your useful life. You are estimating your useful life. The estimated useful life of the property is 8 years. Meaning, what's next? What's the next adjustment that we have? Next adjustment, what do we have? Depreciation. W3, depreciation. There you go. So you have your cost now. Cost is 36,000. Depreciation is how many years? 8 years, correct? 8 years. Therefore, depreciation value will be equals 36,000 over 8, which is 4,500. Are we clear? Get online. Are we clear? Everyone? Okay, double entry. Debit cost of sales. In the exam, your examiner wants you to take it to cost of sales, so you debit cost of sales. Credit accumulated depreciation. Debit cost of sales and credit accumulated depreciation. Now, okay, Zian, look, cost of sales. My school teacher told me, my accounting teacher told me, okay, you don't take it to cost of sales, you take it to distribution cost. That's how I studied in my school. No, 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 no. Your examiner, FR examiner, has 2 PhDs in accounting. Your examiner says to take it to cost of sales, take it to cost of sales. Your examiner says to set it off against revenue, set it off against revenue. Your examiner says to take it as a part of any expenses, take it a part of any expenses. Now, don't try to argue with your examiner. No, Ivan Pila, he is wrong, I am correct. Don't try to negotiate things like that with the examiner. Your examiner says something, please do it. And who is your examiner? Examiner is directly monitored by one of the persons who is that is SBR examiner. Your SBR examiner is a part of the IASP board. Do you know what's the board? International Accounting Standards Board. It's a panel of experts who set accounting standards. Now, for example, let's say IAS 16, your examiner is a part of that board. So examiner doesn't go to Kaplan or study up or anything like that. Examiner sets their own accounting standards and they work on questions based on that. So don't try to negotiate or challenge the examiner. Okay? The examiner says cost of sales, please take it to cost of sales. Clear? Okay, done. Fresco makes an annual transfer to retained profits to reflect the realization of revaluation surplus. In Fresco's tax jurisdiction, the revaluation does not give rise to a deferred tax liability. Now, all this looks very complicated. Yeah, don't complicate yourself. Let's take it very slow. Okay, it's something very simple. Don't try to complicate yourself. Okay, I think this is where most of the students got confused. Okay, Rian, what is this annual transfer to retained earnings? What is this annual transfer to retained earnings? Fresco makes an annual transfer to retained earnings to reflect the realization of revaluation surplus. In Fresco's tax jurisdiction, the revaluation does not give rise to a deferred tax liability. So don't worry about that. Now let's try to understand what do they mean by this, right? Now, guys, hopefully can I use this? Now, guys, let's take a building. Let's say you have a building, right? The value of the building is $1 million, for example. Okay, how much is it? $1 million. Now, what is happening? You're going to revalue the building. You're going to revalue the building to 1,500,000. So if you revalue, there is a 500,000. What is this? It's a gain. Where do you take the gain? OCI. Brilliant. Why do you take it to OCI? Why do you take it to OCI? This gain does not impact profits because we don't show it as a part of our P&L. We show it separately under other comprehensive income. Why? Because it's not a realized gain. Just because I say the value has gone up, now we have these premises, right? It's about 10,000 square feet premises. This will easily go about 200, 250 million. About 20 crores, this property will easily go. It's big, it's massive, right? So I say 200 million today, but tomorrow I say 300 million. Next week I say 400 million. So I can increase the value. But just because I say, is there cash flows coming in? No, it's not realized cash flows. Because it is not realized cash flows, I have to take it to other comprehensive income. Why? If I take it to my P&L, to my profits can be overstated, yes or no? I can simply use this. To overstate my profits. If I'm allowed to take it to my P&L, simply because of this, I have to take it to other comprehensive income. Clear with that? Now there's another problem. Let's say this building's useful life is 10 years. So I would have charged 100,000 depreciation every year before revaluation. Let's say I revalue. After I revalue also, the useful life is 10 years. Now how much will I charge? 150,000 every year, correct? Correct. Depreciation. Does this affect my profit? Yes or no? Is it a P&L item or OCI item? P&L item. Yes or no? Are you sure? Just now, right before I told you it comes under cost of sales, right? Then how do you go to admin? Okay, okay. Anyway, it is a P&L item or an OCI item? P&L item. Okay, okay. At least that you're confident, right? So yes, P&L item. So if it's a P&L item, it affects our profitability. Yes or no? Yes or no? If it's a P&L item, obviously, right? It affects our profitability. So that means depreciation by default, it affects our profitability. Yes or no? But now I'm going to revalue. The value goes up. But does this value affect our profits? Does this value increase in value? When it comes to a revaluation, does it affect our profits? No, because we take it to OCI, right? Other companies, that's what you told me, right? However, if I revalue, my depreciation is going up. Will this increase my profits? Decrease my profits? Will an increase in depreciation impact my profits? My dear, yes, it will. Because last year I was charging 100,000. This year I'm going to charge 150,000. From last year to this year, there'll be an increase of 50,000 in my profits. Sorry, in my depreciation. Meaning my profits will come down by 50,000. Yes or no? Okay. Now, here, I am not allowed to take this 500,000 to my P&L because it is unrealized. But my profits are being affected for something unrealized by 50,000. Meaning, my profits are coming down by 50,000. If it's unrealized, I have to take it to OCI. But the impact of that is bringing down my profits because my depreciation is going up. Is it fair or unfair? Unfair. Companies did not revalue as a result. Why? Because if I revalue, I will take it to other company's income, show it separately. But my profit is coming down, meaning from a board of directors point of view, directors' performance is coming down. Because of that, it's a choice, right? Cost and fair value model. Because it's a choice and it is affecting their performance, they did not revalue. Standard identified, okay, there's a problem. There's a problem. There's a confusion. So standard wants to give a solution for a problem, right? So because of that, the standard came out with a solution. The standard says, okay, fine, we understand. There is additional depreciation as a result of revaluation. Additional depreciation as a result of revaluation. Revaluation is taken to other comprehensive income. But this additional depreciation is affecting your profits. We want you to revalue, but we want you to revalue comfortably without affecting your profits. Because of that, this additional 50,000 is there, right? We are allowing you to reverse it. Reverse it as a gain to retained earnings. Meaning, you will charge depreciation, debit depreciation to cost of sales maybe 150,000 and credit accumulated depreciation 150,000. No. From last time to this time, what is the increase in depreciation? 50,000. This 50,000, you can reverse it in statement of changes in equity. How do you reverse it? Your profit has come down? No. Your profit has to go up. You will credit your retained earnings, that is your profits, by 50,000. And there has to be a debit entry, right? Obviously, if there's a credit entry, there has to be a debit entry, right? Then it says set off against revaluation reserve itself. Meaning you will debit your revaluation gain 50,000. We call this excess of depreciation transfer after revaluation. Excess of depreciation transfer after revaluation. Clear? Now here, in this case, if you look here, they are revaluing now. Okay, they say the remaining life of the lease property is 8 years. In other words, before revaluation, what is the cost of the asset? Excess depreciation would obviously be, now look here, listen to me very carefully. You had 32,000, your useful life. Your useful life was how many years? 8 years. And then it became 36,000. Still it's 8 years. So equals 32,000 over 8 gives you 4,000. Now 36,000 divided by 8 gives you how much? 4,500. How much is the excess depreciation? 500. This can be transferred to retained earnings. Whatever you are charging here, excess in excess is set off against the revaluation reserve. Meaning here, what we can do is we can credit retained earnings, debit what? Revaluation reserves. 500, 500. Understood? Yes or no? Understood? Everyone, is online? Understood, everyone? Now here, in this particular instance, when they say Fresco makes an annual transfer to retained profits to reflect the realization of revaluation surplus, that's what they mean. So don't get confused. It's a very simple, straightforward thing. But now you know the logic. Okay? In the exam, you have to look at the difference and set off the difference. Don't worry, with this question, I'll teach you how to do that also. Super. Guys, in every exam session, you will get non-current assets tested. At least for about 3 to 4 marks. It is tested in every exam session. In every exam session. How much is it tested for Shadila? Shadila, right? Shadira. Shadia. Shadia, how much is it tested for? 3 to 4 months. Are we clear? Brilliant. That's done. On 1st April 2011, Fresco acquired an item of plant under a lease agreement. The moment you see lease agreement in the exam, forget about everything. Just put up a T account. That's it. You see leases, just put up a T account. One T account. Working number 4. Lease payable account. We put up a T account. We call it lease payable account. That's it. Nothing else. Let's not confuse ourselves. Okay? Very simple. So let's insert. There you go. A T account. You know, you don't have this flexibility in the exam. You have to just simply make sure that You can do it on your working paper. You can use working paper. You'll be given A4 sheet papers. You can do it in that also, no problem. I'm happy. Okay, there you go. I want you to simply put up your lease payable amount. That's it. That's it. Nothing much. Okay, I'll give you time to write. Okay, don't worry. I'll give you time to write. Try to understand. In the exam, when it comes to leases, you have few things that you need to get. Number one, you need to get the net book value of the asset. Net book value is your cost minus depreciation. So for that, you need to get your depreciation. So that's the second item that you need to be familiar with. Number three, you need to know lease payable for current liability. Non-current liability, lease payable is also required, and finance cost. These are the five things that you need to know. Okay. Now, even before reading the question, all what I did was I put up the T account. That's it. First condition, T account. Second thing, you need five elements, five things from the note. You need to calculate depreciation, NBV, net book value, lease payable for next year, non-current liability, lease payable, and finance cost. Now let's go. Let's go to the note. On 1st April 2011, what's your year end? Always keep an eye on the year end, 31st March. So how long has it been? It's been a year. On 1st April 2011, Fresco acquired an item of plant under a lease agreement that had an implicit finance cost of 10% per annum. This is your finance cost. Lease obviously comes with a finance cost. No, they're not going to give you free of charge. The lease payments in the trial balance represents an initial deposit of 2 million paid on 1st of April 2011. And the first annual rental of 6 million paid on 31st March 2012. Now you are paying your rental of 6 million on 31st March 2012. You acquired on 1st of April 2011, but your first installment you are paying on 31st March 2012. You are paying in advance or in arrears. Oh, well done, Neha. You're brilliant. Advance or in arrears. Okay, let me tell you. In advance means you pay and use. In arrears means you use and pay. Arrears. Why? Because you are acquiring on 1st of April 2011, but you are making your first payment on 31st March 2012. Correct? Correct. The lease agreement requires annual payments of 6 million at 31st March each year for the next 4 years. For the next 4 years, you are going to make payments. The present value of the lease payments, excluding the initial deposit, was 23 million. Plant and equipment is depreciated at 20% per annum using the reducing balance method. Next, it's about depreciation. We'll come to that. Don't worry. Here, you put up the T account, no. Lease payable. Payable is a liability account, no. All what you need is the brought forward figure. Correct. Payable is a liability account. Liability is in the debit or credit side. Credit side. You require the brought forward figure. Brought forward figure is your present value figure. How much is this? 23,000. Always exclude the deposit. For deposit, you don't have to pay interest, no idea. So you have to exclude the deposit. Sometimes your examiner would have said, no, it's 25,000, including the deposit. So deposit is 2,000. They've told you already. So you'll remove it and you'll say 23,000, for example. Are we clear? Are we clear? Okay. So brought forward 23,000. Shadi, look, I'll give you time to write. Take it easy. Come down. I'll give you time to write. Take it easy. Now you have your brought forward figure. No. So on this, every year, if you're taking a loan in terms of lease, you have to pay finance cost, correct? So the next component is finance cost. So you need to know on your liability, you have to pay finance cost. and then every year you're paying cash, no, that has to be deducted as well. So you take your cash this thing also. Every year, how much are you paying? How much are you paying every year? Guys online, how much are you paying every year? 6 million. So 6,000. Credit cash, debit this account. Simple as that. And then you have the finance cost. Finance cost is in advance or in arrears? In arrears. So arrears means it's your 10%, no? So equals 23,000 into 10%, 2,300. If it is in advance, this 23,000 minus 6,000 into 10%. But if it is in advance, you have already made the payment, no? Therefore, you don't have to calculate finance cost on that particular year. If it is in arrears, you're going to pay at the year end, no? So therefore, finance cost has to be calculated. So therefore, 23,000 plus 2,300 is 25,300. 25,300 carried forward. 25,300 minus 6,000, 19,300. Was that difficult? No. But one thing that you need to keep in mind is, right now, currently, your year is 31st March 2012. Correct? 31st March 2012, no. From the point of acquisition till now, how long has it gone? When did you acquire? 1st of April 2011. Today it is 31st March 2012. How long has it been from the point of acquisition? 12 months. If it's 1 year. If it's 1 year, your calculation will go on till next year. Let's say from the point of acquisition to your year-end date, it's 2 years. Your calculation will go on till the third year. If it is 4 years, then how long will it go until? If it's 4 years, until 5 years, you have to do the calculation. If it is 9 years, but in the exam, your examiner won't go for 9 years. It'll just be 1 or 2 years. That's it. So in this case, for how long will I calculate? Twice. So this is your first year. On top, that's your first year. Now we are moving on to your second year. So second year, very, very, very simple. Right, in the exam, your brought forward equals 19,300. No, correct? Okay. All what you have to do is come here, copy, paste. Copy, paste. That's it. You get your answer in the exam. Simple. Okay. Now, what you got to keep in mind is 1 year since acquisition to my reporting date. So I have done my calculation for 2 years. If it's 2 years, I'll go on for 3 years. That's the mindset. Here, I stop at this point itself. At this point, I require few things. What do I require? I need the net book value of the asset. Net book value. For me to get my net book value, I need the cost of the asset. No. What is the cost of the asset? 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 Well done, Mervin. Well done, Shenuri. Cost of the asset is 23 million that you're paying here, plus your initial deposit of 2 million. That's the total cost of the asset, right? Or in other words, Okay, they are showing it separately. Okay, there you go. Your cost of the asset is 23 plus 2, 25. So there you go. Your cost of the asset is 25 million. Your depreciation. What is the depreciation policy? How many years? The lease agreement requires further annual payments of 6 million on 31st March each year for the next 4 years. So 4 years, current year, 1 year, total 5 years. Useful life, brilliant channel. So that's going to be 5 years. In other words, 25,000 over 5. 5,000 will be your depreciation. Therefore, technically, if you look at the net book value equals 25,000 minus 5,000, 20,000 is the net book value relevant for my balance sheet, correct? 5,000 is my depreciation. And then I have my current liability. Current liability is always current liability, my guys, my students, please listen to me. Current liability is always equals 6,000 here, A. Cash is A minus 1,930, 4,070. That's your current liability. Your non-current liability is always C. So I can say A, B, C. If it is in advance, it will change. When I do an advanced question, perhaps I'll explain you that. So A minus B is my current liability. C is always non-current liability when it comes to address. And then I have my finance cost. I've already calculated. 2,300 is my finance cost for the current year. That's it, done. Are we clear? Okay, okay. If you want, you can copy it. Okay. Fine, you can copy it. How are you? Where do you come from? In progress. Sorry guys, I was talking to someone in here, so don't worry. Take it easy. You okay, everyone? Are you done? Okay. Guys, are you clear? You can sit if you want, no problem. No, Santosh, you will not be receiving the recordings. Okay, guys, like I told you, lease is also an important area in your syllabus. It will be tested. It can be tested for about 4 to 5 months. So there you go. We're done with this point as well. Are we clear so far? Is that clear? Is that no? Yeah. And then they say plant and equipment other than the lease plant is depreciated at 20% per annum using the reducing balance method. And finally, they say no depreciation or amortization has been charged on any non-current asset for the year ended 31st March 2012. Depreciation and amortization are charged to cost of sales. So depreciation is one of your examiner's favorite areas, and in every exam session, you see depreciation. And it's not tough as well. I mean, obviously, from grade 8, 9, 10, you're studying depreciation. But if you're a science student like me, probably you get to know depreciation when you start ACCA. So yeah, that's where you start, but that's okay. You can still be successful. I have to tell you, if you're a science student, most of the time science students are very successful when it comes to ACCA. I'm not joking. Most of the prize winners, when you see, it's science students. They tend to grab it very quick. But anyway, depreciation is a straightforward thing, and I want you to start calculating it. I'll give you a minute. Let's see if you're getting it right. If not, let's do it together. Okay. You want me to go to the top? There you go. They say plant and equipment other than the lease plant. Lease plant, we have completed, we've done with the depreciation. So we don't have to worry about that. It's depreciated at 20% per annum using reducing balance method. So you've got your plant and equipment at cost here for this 1,500, correct? Your accumulated depreciation for plant and equipment is 33,500. So they are using the reducing balance method. So let's go back. W5, working 5, depreciation of plant and equipment. So it is reducing balance method, so you don't have to worry. Cost minus accumulated depreciation. How much is the cost? Cost is given as, hello, you okay, everyone? Yeah, please give me the answers. 47,500, brilliant. 47,500. And then you have 33,500. Oh, 33,500. This plus this 14,000 into 20%, 2,800, correct? Are you clear? Understood. Are we clear? Yes or no? Okay, brilliant. So debit, cost of sales, credit, accumulated depreciation. There you go. So we are entirely done with this working, right? Guys, generally, this particular adjustment entirely will give you about 5 to 6 marks in the exam. It's crucial, right? 5 to 6 marks in the exams. Yes or no? Not crucial. Yeah, obviously, right? It is right. Okay, let's go back to the third point. In March 2012, so no depreciation amortization has been charged on any non-current assets. We have already calculated for everything. And depreciation and amortization are charged to cost of sales. Examiner says cost of sales, no negotiation. My teacher told me distribution cost, A-level teacher, O-level teacher, no, forget about it. Cost of sales, examiner says we take it to cost of sales. No negotiations there. Okay, brilliant. In March 2012, Fresco's internal audit department discovered a fraud committed by the credit controller who did not return from a foreign business trip. Okay, so you have your credit controller. This bugger went on a foreign business trip after committing a fraud. The outcome of the fraud is that 4 million of the trade receivables have been stolen by the credit controller and are not recoverable. So 4 million not recovered. Who did it? The credit controller. Of this amount, 1 million relates to the year ended 31st March. So out of this 4 million, 3 million to the current year, 1 million to last year, and the remainder to the current year. Fresco is not insured against this fraud. If you have not insured against this fraud, you're not going to receive any money from the insurance company. So 4 million, it's entirely your loss. Are we clear? Yes or no? So basically, out of this 4 million, 3 million relates to this current year. You're not going to receive this money. But 1 million relates to the last year, previous year. Therefore, how do you account for this 1 million? How do you account for this 1 million? Yeah, anyway, this 4 million is irrecoverable, right? Not just 1 million. 4 million itself is irrecoverable. Well done, Akash. Deduct from opening retained earnings. This 1 million will be accounted in line with IAS 8 accounting policies, changes in estimates and error. IAS 8 accounting policies, changes in estimates and error says that error is technically, error can be intentional or unintentional. If it's intentional, it is fraud. If it's unintentional, it is a mistake. So, errors, basically error in the financial statements can cost due to a fraud or a misstatement. Fraud is deliberate. Fraud is deliberate. Maybe this deliberation can come from pressure. My wife wants to go on a honeymoon package. I don't have money. Probably I'll try to steal. She says, no, if only if you go on the honeymoon package, I will not probably divorce you. Could have happened to A.R. Rahman, right? You know, but obviously A.R. Rahman doesn't have to steal. You know, right? They got divorced. Yeah. And when they got divorced, A.R. Rahman's assistant also got divorced, right? So I don't know why they got divorced. But anyway, coming back, error can be intentional, which is a fraud, or unintentional, it can be a misstatement. In this case, it is intentional. IAS 8 says, if you have error not discovered from last year, if you are bringing it this year brought forward, it has to be adjusted in the opening retained earnings. Meaning, guys, this 1 million has to be adjusted in the opening retained earnings. The 3 million has to be technically set off in the current year. But entirely 4 million is not recoverable. So working number 6W6, we have a fraud. So I'm not going to receive my trade receivables entirely. So I credit my trade receivables. How much? How much do I credit? I will credit 4 million. I'm not going to receive this entirely. I will debit my current year P&L with 3 million, and I will debit opening retained earnings 1 million. Are we clear? Are we clear? Understood? Okay. Last point. Taxes. Oh, sorry. One before the last. Taxes, but most important. Shadia, you go to the examination hall. You don't see a tax calculation in the examination hall. What are you going to do? Huh? You don't see. It is not there in the examination hall. What are you going to do? No. You just stand out of the examination hall, come out. There can't be an FR paper without tax adjustment. Every exam paper of FR will have tax adjustment. So basically, you have applied for the wrong paper. That's the reason you have to come out of the examination. Probably you have applied for tax or FPM or something like that. FR exam will have this tax element for about 3 to 4 months. How do you do it? You need to know my steps. Apply the steps, you'll get the answer. Okay? Shall we? Shall we? Okay, let's read the question. Fresco's income tax calculation for the year ended 31st March 2012 shows a tax refund. Okay, forget about all those. Forget about all those. We don't need all those. We don't even have to read that part. What are my steps? Tell me my steps. Step number 1, what do we do? Put up 3 tier accounts. As simple as that, right? There you go, Akash. Brilliant. Put up 3 tier accounts. Okay, that's it. Very simple. Okay. So let's put up 3 tier accounts. Okay. Tier account number 1. Okay. If you want to go, you go. Okay. It, it looks like, she's hungry. If you want to go, you can go. Okay. But if you want to stay, you can stay. So guys, we're going to put up 3 tier accounts. This one, it's detailed. Very detailed. But for you, it looks like it's LL accounting. You know the FAR paper of AAT, right? You did AAT, right? I taught that paper. Okay, I did FAR and I taught FCA. That's only about 10% of the syllabus. A level, if you take about 15% of A level, that's very detailed. Yeah, so you put up 3 tier accounts. 3 tier accounts. You call it income tax account. There you go. Tax payable account. Tax payable account. And then deferred tax account. Guys, was that difficult? Now, if you come and tell me that is difficult, please stop doing ACCA. Putting up 3 tier accounts. Was that difficult? No. What is the second step? Take the brought forward figures. Brought forward figures, where you get it from? You go to the trial balance. Okay. What are the brought forward figures? You have your current tax here. You have the deferred tax here. Yes or no? Current tax is on the debit side, 800. Deferred tax is on the credit side, 3200. Correct. So brought forward 800 and then brought forward 3200. Done. Oh, wait, I'll give you. Don't worry. We are not competitors. I'll give you time to write. Okay. I did FR like 10 years back. Don't worry. Okay. I'll teach you everything that I know. I will teach you. Don't worry. I'll teach you everything, every little thing. I'm not your competitor. Okay. Don't try to compete with me. Okay. Let's go down. Fresco's income tax calculation for the year ended 31st March 2012 shows a tax refund of 2.4 million. Yes. If it's profit, you pay taxes. You get a tax refund. Now, what do I mean by tax refund is HMRC won't come to your home and give you money. No. You're making a loss. So it's unfair to charge tax on you. When you make a profit, it's fair to charge tax on you. So if it's a loss to pay tax, instead you get a tax refund. Not that you're going to get money to your account. No. When you make profits in the future, you can set off. So you'll have a credit entry with you. You'll have some asset with you. So when you have to make, I think your lecture is starting the class. No, please not. So when you make a profit, you can set off with loss against the profit. You understand my point? So you pay taxes when you make a profit. Now, in this case, technically the company is making a loss. In other words, the moment your examiner says this, you know when you're calculating your P&L, it has to be a profit or loss. When you're doing your P&L, it has to be a profit or loss. Your final figure. There has to be a loss, no, because your examiner is saying it's a tax refund, no. You pay taxes only when you make a profit. So in this case, when your examiner is saying it's a tax refund, your P&L, it has to be a loss, right? So they say it shows a tax refund of 2.4 million. Meaning all this while you debited income taxes and you credited tax payable, no. Now you're going to reverse it. You're going to credit income tax and debit your tax payable account. You're going to show a receivable. How much will the receivable be? It will be 2,400. You will come to your income tax account. You're not going to debit it. Instead, you're going to credit it. You're going to say tax asset. How much is that? 2,400, 2,400. And then you come here. You don't have a payable. Although I call it payable, it's a receivable. We'll show it as an asset. You'll say income tax 24. Are we clear? Are we clear? Bye. Are we clear? Understood? Now let's go further. The balance on the current tax and trial balance represents the over or under provision of the tax liability for the year ended 31st March 2011. At 31st March 2012, Fresco had a taxable temporary difference of how much? 12 million, requiring a deferred tax liability. The income tax rate is 25%. Accounting written on value minus tax written on value into tax percentage. Sometimes they'll directly give you the deferred tax value. Sometimes you'll have to do the difference. They'll give you the accounting written on value and tax written on value. Sometimes they'll deduct and give you the tax base. Now, here when they say temporary difference, they have already calculated the difference and given you this 12 million. All what you have to do is 12 million into 25%. In other words, carried forward will be equals 12,000 into 25%. That's it, done. So 200, 3,200, you have a 200. Where do you take this 200 to? You'll take it to your IT income tax account. Well done, Neha. So you come here to the top. If it's a debit here, you are going to credit here, correct? So you're going to say deferred tax, how much? 200. Total 2,600, 2,600, 2,600 minus 800, 1,800. Where do you take? PNL. Debit or credit? PNL. You debited here means PNL will be credited. And then 2,400, 2,400 carried forward, 2,400 brought forward. It will be a tax asset of 2,400 on your debit side. That's it. Was that difficult? You want to copy? You can copy. It's done. It's not done. Others? Done. Okay. The investments had a fair value of 7.2 million as of 31st March 2012. There were no acquisitions or disposals of these investments. You look here, they say equity financial asset investment is 6,000. So that means you got W working 7, taxes, and then working 8, investments. You have two things, book value and fair value. Correct. Book value is 6,000. Fair value is 7,200, meaning the value has gone up. So the value has gone up, is it a gain or a loss? 1,200 fair value. Okay. Now they say it's equity financial asset. Equity financial asset. Condition satisfied or not satisfied? Business model test, cash flow test. Equity financial asset means where do you take it? Well done, Mervin. Good job. Cash flow test, business model test. Well done, superb, Mervin. Well done. How do you indicate it? You've never heard of something like that. So, guys, this is an IFRS, and I mean, obviously, I can't take you through in detail. I don't have the time. But we've got conditions for taking to fair value through OCI or fair value through PNL. If it's fair value through PNL, conditions not satisfied. What are the conditions not satisfied? Business model test and cash flow test. Business model test means you're going to hold the investments until maturity. Cash flow test means you expect constant cash flows from the instrument. Maybe you're talking about capital repayments and interest payment. Now, when you take equity, do you have maturity period? When you are investing in ordinary shares, do you have a maturity period? No, you don't have a maturity period. If there is no maturity period, that means business model test is not satisfied. Therefore, you take it to the PNL. So because there is a gain here, 1,200 fair value taken to the PNL. In other words, you will debit your investments, credit the PNL. Are we clear? Are we clear? Take it and let's do the PNL together. PNL comprehensive income together. Sorry, guys. There was a parent who came and I was talking to the parent. Okay, done. This is done now. Schedule the P&L. In the exam, this is how it's going to look like, okay? We're going to have split view. This is exactly how it will look like in the exam. So we're going to work on Fresco's P&L. So Fresco's statement of profit or loss for the year ended 31st March 2012. Are we clear? Are we clear? Shall we? Shall we do it? You're going to do it or shall I do it? Or shall I do it together? Let's do it together. Okay. Number one, revenue. How much is the revenue? Your revenue is 350,000 over here. So equals 350,000. Did you make any adjustments to revenue? No, you should know. By now, you should know your workings. No, revenue did not make any adjustments. So next, cost of sales, correct? So for cost of sales, what do you need? You go to the question. How much is the cost of sales in the question? They say the cost of sales here 298,700, correct? Did you do any adjustments? Yeah, you did adjustments. So you have to go back to your workings, not to your notes. You have to go to your workings, not to your notes. Your workings, your share issue, no impact. Your revaluation, no impact. There you go. You have depreciation. How much is that? Number one, 4,500. Number one. What else do you have? 4,500 is accounted. And then for leases also you have depreciation. How much is that? 5,000. Brilliant. Plus. And then what do you have? Once again, plant and equipment, 2,800. Correct. Anything else? Fraud, I have to debit P&L. I'll take it to my admin expenses, okay? And then I have taxes. And then I have investment. So that's okay. I have total of 207,000. Done. Next gives me my gross profits. 350 minus 311, 39,000. Are we clear? Next, I have my admin expenses. How much is my admin expenses? They say admin expenses is 26,900, correct? Equals 26. Oh, before admin expenses, yes, that's right. I have to take my incomes, other income. In my other income, there is a fair value gain, correct? How much is the fair value gain? Do we have any incomes here? No, right? How much is the fair value gain? We had 1,200, is it? Yeah. 1,200. That's a fair value gain. After the income, what do I take? Admin, expenses, and distribution cost. Not cost, it is cost. Admin expenses is 26,900. 26,900. Do I have any adjustments to make? Let's come to the workings. Depreciation, leases. There you go. Fraud. I have a 3,000 to increase. Am I right? So plus 3,000. There you go. 29,900. And then I have distribution cost. Distribution cost is 16,100. I remember we did not make any adjustments to distribution cost. Correct. So I have my operating profits. Are we clear? So equals 39,000 plus 1,200 minus 29,900 minus 16,100. I believe it is a loss and not a profit. 5,800 loss. Are we clear? So we have an operating loss. Do you remember your examiner says it's a loss, right? There you go. Once that is done, I have to account for finance cost. How much is the finance cost here? Finance cost here is 300. They've already given in the P&L, correct? Did we do any calculations? Yes, leases, 2,300. There you go. 300 plus 2,300 gives me 2,600. And then I have my profit before tax equals minus 5,800 minus 2,600, 8,400 negative, correct? And next I have my taxes. Taxes also we calculated, but this time we have a tax refund, right? Remember? How much is that? 1,800. So it's a positive figure, yes or no? Generally taxes are negative, but in this case, it's a credit entry. So therefore, equal sum. How much do we have? 6,600. Loss after tax. It's LAT. Loss after tax. Are we clear? Done? Guys online, are we all clear? Yes or no? Okay. Shall we also do the statement of other comprehensive income? Okay. Fresco's statement of other comprehensive income for the year ended 31st March 2013 or 12? 13 or 12? 12. Okay. What do I need when it comes to statement of changes in equity? Actually, my equity section in my balance sheet. So I'll have my brought forward. I will have my share capital, share premium, revaluation reserves, and then retained earnings. These are my brought forward figures. Okay, share capital brought forward is how much? 45,000, correct? Share premium is how much? 5,000. Revaluation brought forward, 0. Retained earnings brought forward, 1, 2, 3, 1, 2, 3, 5,100. Did we do any adjustments here? To our share capital, did we do any adjustments? Issue of shares. Issue of shares. Remember, for share capital, how much should we take? I'm going to credit share capital by 9,000. Share premium, I'm going to credit by 4,500. There you go. Simple as that. Revaluation. Do I have any adjustments to revaluation? Did we revalue? Did we do any revaluation? Yeah, this is my statement of, statement of, not other comprehensive income. Sorry, statement of changes in equity. I'm sorry. Statement of changes in equity. I'm sorry. Changes in equity. It's not other comprehensive income. I'm sorry. But are they asking me to do other comprehensive? Yeah. They require us to do other comprehensive income. We didn't do other comprehensive income. I'll come there. Don't worry. Neha, thank you. So revaluation. What do we have for revaluation? There is a revaluation gain. How much is the gain? 4,000. Not 40,000. It's 4,000. Done. Next, retained earnings. Retained earnings, profit or loss? We have a loss of minus 6,600. Are we clear? But now I have brought forward 5,100, then I have 6,600 negative loss, right, from here. So what is retained earnings? Opening brought forward retained earnings plus current year profit. Okay. But don't forget, there is a transfer from revaluation reserve to retained earnings. What is this transfer for? Excess depreciation. So depreciation excess. How much is the depreciation excess? I remember it was 500, right? So minus 500 here and to retained earnings plus 500. Any other adjustments? Any other adjustments? Any other adjustments? Exactly, fraud, error. There you go. How much is the error? 1000 I have to deduct minus 1000. Now, guys, do you see? I never went to my notes. I always went to my workings. In the exam, you don't go to the notes at all. You only go to the workings. Done. That's it. Equals sum 54,000. Copy. Paste. 9,500, 3,500. And then minus 2,000. All done. All done. I can come here and I can put my statement of other comprehensive income. So Fresco's statement of other comprehensive income for the year ended 31st March 2012. What do I have? There is a revaluation gain. How much is the gain? 4,000. And then there is excess depreciation. How much is that? Minus 500. Therefore, net gain will be here 35. Are we clear? Understood? That's it. Are we clear? Are we clear? Yes or no? Everyone? Yes online? Are we clear? Quick, quick, quick. Okay, that's a 20 mark question that we have looked at. I know I've taken approximately 2 hours for it, but I was explaining you each and every point. In the exam, you can't take for this more maximum 40 minutes, not anything more than 40 minutes. So yeah, we need to make sure that you are in line with the timing. Okay. Shall we take a break and then continue? Or you want me to continue? What do you want me to do? But guys, how are you finding? Are you comfortable? Any areas of difficulties that you want me to help you further? Guys online? Neha, Akash, B, Lingeshwari, Movin, Santosh, Shenuri, Shyamjit, Vasant. Vasant, you messaged me something, right? Can you work out a consultation sum? Okay, Akash. We'll do a consultation. Okay, everyone says consolidation. We'll do a cash flow also, don't worry. Okay, shall we? Okay. Why gym? P&L question? Okay. Take go. Go to the requirement. Okay, Vasant, I'll try to look at it by tomorrow. Okay. Requirement: calculate the consolidated goodwill at the date of acquisition, and then prepare the consolidated statement of profit and loss for Gem for the year ended 30th September 2012. Two requirements: goodwill and then P&L can be tested. Goodwill with the P&L can be tested. Okay. Take few minutes. Go to the question on your own. Go to the question and give me a done. Done? Try to go through the adjustments. That's enough for me. Let's start, everyone. Okay, super. Now, guys, here the requirement is number one, calculate goodwill on acquisition at the date of acquisition of Reka. And number two, prepare the consolidated P&L for YGM for the year ended 30th September 2012. Okay, when you go to the question, okay, on 1st January 2012. Okay, now what I'm going to do is I'm going to take you to the question entirely. And we have done a P&L question earlier. No? I want you to do it on your own. And then I'll do the answers with you. Okay. Okay, so we can see where you're going wrong also. No? Super. But I'll take you through the adjustments together. On 1st January 2012, YGM acquired 90% of the equity share capital of Reka in a share exchange in which YGM issued 2 new shares for every 3 shares it acquired in Reka. So here, number one, it's your investment cost, no guys. It's your investment cost. So basically, why is this relevant? This is relevant. This is relevant for your goodwill calculation. Additionally, on 31st December 2012, YGM will pay the shareholders of Reka 1.76 per share acquired. So based on the share that you are going to acquire, you're going to make a deferred payment of $1.76 per share. We have looked into it earlier also. YGM's cost of capital is 10% per annum. The deferred consideration has not yet been recorded by YGM, meaning you have to record it. At the rate of acquisition, shares in YGM and Reka had a stock market value of 6.5 and 2.5 each respectively. So basically, they are giving you the P&L and they are giving you the balance sheet. Now, if you are trying to work around the investment cost, right? If you're trying to work around the investment cost, you have 2 shares for every 3 shares it acquired. No. So there is a share exchange, number one. And there is a deferred payment. So you have to calculate that. You need to keep that in mind. So when you're going to do it on your own, you're going to do that calculation. Are we clear, everyone? Yes or no? Are we clear? So, revenue, cost of sales. When are you acquiring? On 1st of January 2012. And your year end is 30th September 2012, meaning it is a mid-year acquisition. We have looked at a question in terms of mid-year acquisition earlier also. So you need to make sure that your revenues and expenses are time apportioned. How many months? 9 months. Of subsidiaries time apportioned. Revenue, cost of sales, TP, distribution cost, admin, investment income, finance cost, profit before tax, profit for the year. What do you have? Equity shares and retained earnings. The following information is relevant. At the date of acquisition, the fair values of Reka's assets were equal to their carrying amount, with the exception of 2 items. They say at the date of acquisition, no. So basically, this becomes relevant for our goodwill calculation. The fair values of Reka's assets were equal to their carrying amounts, with the exception of 2 items. An item of plant which had a carrying value of 1.8 million above its carrying amount. So 1,800 is a revaluation surplus. So will it be relevant for my goodwill calculation? Yes or no? Will it be relevant for my goodwill calculation? Yes or no? Yes, because at acquisition, all the figures are relevant for my goodwill calculation. That's what I told you, remember? So when I'm calculating my goodwill, I will take this also. Consider this also. The remaining life of the plant at the date of acquisition was 3 years. So for 3 years, you will have to calculate depreciation. But here, when you're working on depreciation, you need to make sure you apportion it for 9 over 12 months. Because only 9 months have gone. Are we clear? Everyone? Greca had a contingent liability, a liability which YGM estimated to have a fair value of 450,000, meaning it's a liability which you have deducted from your retained earnings. So since it's at the rate of acquisition, so at the rate of acquisition, you have to take the retained earnings and adjust for it. Greca has not incorporated these fair values into its financial statement, so you are going to incorporate it. Clear? YGM's policy is to value the NCI interest at fair value at the end of acquisition. For this purpose, Greca's share price at the date can be deemed to be representative of the fair value of the shares held by the NCI interest. They're saying, for you to calculate NCI investments, use the share price of the subsidiary. For example, total shares that our subsidiary has is 10,000 now. So to calculate NCI, basically what you will do is you take 10,000, NCI percentage is how many percent? 10%. Our subsidiary's share value, they have given Greca is 2.5 into 2.5. That's going to be the NCI investment figure. Are we clear? Okay. Sales from YGM to Greca throughout the year ended 30th September 2012 had been consistently been 800,000 per month. So every month 800,000 for 9 months. 800,000 into 9 will be your intra-group transaction eliminated. So from here to here, intra-group sales eliminated from sales and purchases. YGM made a markup on cost of 25% on this sales. Greca had 1.5 million of this goods in inventory. So that is going to be your URP. Your URP is going to be 1,500 into 25 over 125. All these are straightforward, right? Guys, you understand? All these are straightforward, right? YGM's investment income is a dividend received from its investments in a 40% owned associate, which it has held for several years. The underlying earnings for associate for the year ended 30th September, 2012 were 2 million. YGM's investment income. So our parent also has another associate. Are we clear? So it's not only a subsidiary, we have an associate also. So YGM's investment income is a dividend received from its investment in a 40% owned associate, which it had held for several years. The underlying earning for the associate for the year ended 30th September 2012 was 2 million, meaning you'll calculate associate share of profits, which will come to you. That will be 2,000 into 40%, which is going to be 800. Mervin, are we clear, Mervin? Yes or no? Brilliant. Okay. Now, YGM's investment income is a dividend received from its associate. Now, dividend received has to be eliminated. You have investment income of 500, has to be eliminated. That is also required. Although Greca has been profitable since its acquisition by YGM, the market for Greca's products have been badly hit in recent months, and YGM has calculated that goodwill has been impaired by 2 million. So there is a goodwill impairment of 2 million. So basically, if you have a goodwill impairment, you're going to debit your P&L, credit your goodwill. Whatever you do calculation here will be brought down by 2 million at 30th September 2012. So goodwill impairment also should be calculated. Are we clear? Are we clear? Everybody? You want to do it on your own? You want to do it on your own? Okay, brilliant. What I would want you to do is do wire jump on your own. Do wire jump on your own. And then let's meet tomorrow at 6 p.m. to finish off wire jump. Okay, 6:30, fine. Let's meet tomorrow at 6:30. Shadia wants me to do it at 6:30. 6:30 to finish off wire jump. And let's try to meet on Tuesday as well. This week, let's try to meet. No problem. But tomorrow when you come, make sure that you have gone through our gym. And in the meantime, if you want me to do any other questions, further questions, just let me know. I'll try to accommodate it. Everybody, are we clear? Akash, Lingeshwari, Maureen, Neha, Santosh, Shenuri, Shyamjit, Vasant. Are we clear? Can you do pyramid sum tomorrow? Okay, we'll do pyramid. I'll look into pyramid tomorrow. Okay, guys, thank you so much for being here. And I'll see you guys tomorrow. Take care. Bye bye.